Amit Maheshwari to deliberate on the same. Over to you, sir.
So for startups, there have been a couple of good changes and a very draconian change. So further exemption under 80 ISC, they've got 100% reduction of profits if they incorporated from 31st April 2016 to 31st March 14. So that has been extended by 1 year. They also had a saving provisions for carrying forward and set off of losses. There, the period of 7 years have been increased to 10 years now. So that is again keeping in mind that startups generally don't tend to be that profitable, and it takes time. So there is a good gestation period, and going by what the industry is facing now, I think it would take some time for them to become profitable. So these are two expected changes, more about rationalization or extending those benefits which were already there. But I will spend more time on the last thing, on the angel tax. So angel tax have been causing a lot of issues, and right from 2016, where we were part of numerous such developments in the industry, where due to down rounds, startups were getting tax notices, and in every case, valuations were being challenged. So what tax officers were saying was that the earlier round which you did, or whatever the year in question, the round which you did, the valuation at what you did was actually was very high than the fair market value, and we would seek to tax that under this section. So that's a benefit which has gone to the non-resident to the startup, and therefore the startup was getting taxed. So this section was widely ridiculed. People got notices. They had a horrid time trying to explain, and valuations being very subjective, it was not very easy to actually justify at what basis the valuation happened. And tax officers, especially when they had the benefit of hindsight, they were able to claim that, look, this was a ridiculous valuation, and there was no way that you could have been valued. But that those statements came after. I'm so sorry. I just realized I was on mute. I'll just quickly go through this again. So there have been two extensions of existing startup deductions. One on deduction of profits that has been extended by 1 year. Then there is setting off of losses. Coming to the angel tax was an angel anti-avoidance measure. This was basically brought in to circumvent the conversion of black money into white money, which is basically unaccounted money into legitimate money. But that had hit startups hard. Startups got all sort of notices, questioning valuations, tax officers coming after them with the benefit of hindsight, and attacking valuations. Again, with the kind of environment which was there in 2016 to 18, many startups had very crazy valuations, and they were being attacked, and tax officer made additions, and government realized that, came out with several beneficial provisions, where primarily if you were DPIT registered, you would be exempt from that. And again, there were several rulings where it was held that you cannot question the valuation when it is done by a registered chartered accountant. So mostly the valuations were done on a discounted cash flow method, which was subject to litigation, and there was a lot of subjectivity involved because of that. So right from the start, this tax was not applicable to non-resident investors and to registered VC funds in India. Now, what they have done now is they have made it applicable to non-residents as well. Now, with that, what will happen is that if FDI comes in, and that is when you are no longer, you don't qualify as being a DPIT registered startup. So as FDI comes in, this particular premium would get taxed in the hands, whether it is for resident or non-resident. Now, under FEMA, which is our Foreign Exchange Control Act, So under FEMA, you are prescribed to do, you are asked to do a valuation, which is a floor valuation. So FEMA says that you can get FDI at a valuation which is higher than what you do through by an international accepted methodology, which typically becomes your DCF. So FEMA prescribes a floor. However, the Income Tax Act says now that if you do it beyond the fair market value, so then we will tax the differential, we will tax the premium. Now, this becomes very difficult to comply with. And again, with the benefit of hindsight, it is very easy for any officer or even to us, anybody can question any valuation. If you are no longer with DPIT, this becomes a very big issue, and you have very large rounds. We have seen many big startups getting very badly hit in this downturn, valuations crashing by 70%, 80%, having difficulty in raising funds. So this will become a very big issue, and I think this is basically a tax on FDI, which should not be there. There are enough checks and balances in the system to identify whether the money coming is as a legitimate money or not. Even when FDI comes in, the bankers are required to do their KYC, and the tax authorities can definitely question the genuineness of the transaction. But attacking valuations would make it very difficult for startups. Next slide. So again, there have been some views which have come on this matter. Next, please. Business. Yeah. So under in business trust, which is basically REITs and InvITs, real estate investment trust and infrastructure investment trust. So in REITs and InvITs, there were multiple distributions of incomes to the unit holders. It could have been interest income, dividend income, or repayment of debt. And then lastly, it could be selling of the unit itself. But from the REIT or from the InvIT which you held, there were these three streams of income, and they were all accorded a pass-through status. Now, unfortunately, or the way these structures were designed, so there was some element of distribution which was in the nature of repayment of debt. Now, many REITs actually funded their SPVs through debt. When the SPV distributed income, it was coming as repayment of debt. And when the REIT was further distributing it, it was treated as a repayment of debt in the hands of the unit holders because it was a pass-through. This resulted in double non-taxation. So nobody was paying taxes on it. The unit holder, of course, got a regular stream of income, whether it was a 7, 8, or 9% yield, which they were getting. And that yield comprised of dividend income, interest income, and repayment of debt. Repayment of debt was not getting taxed. Dividend has a different tax regime. So this has been now plugged, and they're saying that if you do a repayment of debt, that would be treated as income from other sources in the hand of the unit holder and would be brought to tax. Again, from what we understand and our discussions with several of our clients, there would be industry representations, and this InvITs and REITs are still in infancy stage, but are very essential for the development of real estate, as well as to satisfy India very high demands of infrastructure financing in India. So this would actually reduce the in-hand yield, much higher yields to attract investors. And which will definitely impact the monetization of such assets. What was also there was that there was a section under section 184 LBA, there was a withholding of 5% on interest income for non-resident unit holders, but there was no option of taking a lower certificate. Now there are under section 1023 FE. There are sovereign funds, pension funds, which have been exempt from investment into REITs, from incomes arising from business trusts, InvITs, REITs. And because of that exemption, this 5% was getting deducted. Then you had to file a return, claim a refund. So what they have said is now they have provided that these non-residents can take a lower withholding tax certificate under Section 197, claiming an exempt income. So that was so the enabling section did not have 194 LBA. That is why you could have not applied for it. So this has been rectified, which is a good thing. Next slide. So let's skip this. I think we are short on time. Let's skip this. Yeah. So SEZ units, they get exemption under 10 AA, and what has been held is that no deduction would be allowed if they don't furnish a return of income on or before the due date of filing of return. And also, there is another provision wherein they have said, they have also put another restriction that if you don't bring your export proceeds within 6 months or any period which is allowed by the RBI. So, for example, when we had COVID, RBI had given relaxation of bringing funds. So, if you don't bring it within that period, then again the deduction would go away. So, both these restrictions have come in. Again, they are perfectly logical, intended to provide compliance, and in the second part intended to achieve the policy objective of getting money within time and getting that foreign exchange which India so desperately needs. Next. Yeah, so this is kind of like there has been some strategic investments which are in the pipeline, primarily IDBI, wherein they have tried to change the definition of strategic disinvestment. In a nutshell, they have said that if the central government, state government, or any public sector company holds a stake and wants to reduce that, even that would qualify as a strategic disinvestment. Not only just the stake from the central government or state government, even if it is a public sector company, if that company holds shares, even that would qualify as strategic investment. And there were two conditions which was there for carrying off and set off of losses. One was that the reduction of shareholding should be below 51%, that is how it qualified as a strategic disinvestment. And the transfer of control should also be there. Now, what has been changed is that one is the reduction should be 51%, but if your shareholding was as it is, if the government shareholding was as it is less than 51%, even that would qualify. And transfer of control could be either through the central government, or state government, or the public sector company. So anybody could have been exercising control. What should happen is that all these people who are exercising control should transfer the control. So earlier it was only central government and state government. And I think this has been brought in for giving space to more of an exception, because LIC also has some stakes and it's no longer a government department. It has been listed. It is no longer a completely government-owned company. It's a public sector company now. Carry forward, and so again, if after the strategic disinvestment, if the amalgamation of the banking companies with another banking company within 5 years, then this benefit of carry forward of losses would be there. So they're given time till 5 years for this merger. So you could have a IDBI, let's say an IDBI merging with a private company or whatever. So yeah, next issue. So I will quickly pass on to my colleague Manish to take you through transfer pricing and tax litigation